A founder trying to sell software to lawyers realized no one was answering his emails. To get a foot in the door, he made a highly unusual offer. He paid his prospects $200 an hour out of his own pocket just to sit down and give him feedback on his product. By directly subsidizing his prospects' time, he absorbed a heavy negative margin on every meeting. But that intentional sacrifice resulted in a 30% conversion rate for his highest value accounts. On the opposite end of the spectrum, Costco operates at a scale of hundreds of billions in revenue. They achieve this by intentionally compressing their own profit margins on bulk goods, handing a $5 billion surplus back to their shoppers every single year. This chart plots cash flow against time. Most failures occur when a company attempts to apply the low-margin, high-volume logic of a Costco before they have reached the necessary scale to support it. They drop straight into the red zone, a phase known as Death Valley. These two strategies aren't unrelated. They are different levels of the same operational stack. To survive, a founder must master these mechanics in a specific order, starting with unscalable unit economics to buy early feedback, then transitioning to shared scale economies to build a moat, and finally securing the capital structure to protect the terminal monopoly. If you want to study the mechanics of how elite companies are actually built, make sure to subscribe to the channel. Scaling is not a smooth, linear progression. It is a series of radical shifts, where the tactics that saved you on day 1 will actively kill you once you reach day 1,000. When a company is operating in the 0 to 10 customer range, market volume is a statistical illusion. Nobody knows who you are, and you possess zero distributional leverage. Accountants often suggest lowering prices to drive volume at this stage. This is a fatal error. It attempts to solve a liquidity problem with a volume model that the business isn't yet large enough to sustain. This visual scale shows the reality of early survival. When you only have the attention of a few prospects, you have to maximize the cash extracted from every single user. You need high-ticket wins to generate the oxygen required to stay in the game. This means packaging the highest possible value, visiting offices in person, doing the work for the client, and giving away the kitchen sink. You are trading manual labor and extreme attention for the immediate cash required to survive. Take a second to drop a like and share this video if you are finding these mechanics useful. Survival at the starting line is a function of immediate cash extraction from a concentrated base. It has nothing to do with addressing your total addressable market volume. Once you secure that initial cash, you enter the phase of unscalable deal mechanics. Mass distribution tools like cold email sequences are useless here because your prospects' inboxes are already crowded with established competitors using the same automation. At this stage, customers are making a bet on the person behind the idea. They recognize the product is still a work in progress, but they are willing to sign on because they trust that the founder will personally ensure the problem gets solved. Generating that trust requires extreme physical friction. One founder systematically flew to customer offices uninvited and waited in the lobby. He even flew to Hawaii to ambush a specific executive in person, securing an 8-minute conversation that eventually converted into his largest account. This applies digitally as well. Instead of broad marketing campaigns, successful founders hunt down specific public complaints on Reddit and manually direct message every commenter one by one to solve their problem. This node mark tracks those results. Notice that the automated email lines break apart and fail. Meanwhile, the high-friction pathways, physical travel, and personalized direct messages glow thick with successfully converted accounts. Large corporations possess massive budgets, but their rigid structures prevent them from ever deploying this level of individualized, founder-driven effort. For more deep dives into these specific acquisition tactics, follow along on Twitter. Executing tedious, high-friction tasks signals a level of commitment and reliability that automated software can never replicate. Moving past early survival, a company must architect a permanent moat.
One of the most effective strategies is to capture value by monopolizing the verification layer of an unregulated industry. Economists call these credence goods, items where the true quality is impossible for the buyer to verify on their own, even long after the purchase is complete. The sports card and collectibles market was a perfect example. For decades, the industry was paralyzed by a lack of objective trust between buyers and sellers who couldn't agree on a card's condition or authenticity. Entrepreneur Nat Turner identified this structural flaw. By acquiring the grading company PSA, he built a massive trust layer, forcing all transactions in the market to route directly through his verification system. Once PSA became the street standard, a self-reinforcing loop was created. The market value of a card rises in tandem with its PSA grade, which forces all serious collectors to use their service if they want to maximize their returns. By controlling this checkpoint, PSA gains total visibility into the absolute scarcity and real-time liquidity of every specific asset moving through the market. Monopolizing a credence good allows a company to act as an unavoidable toll booth, extracting a tax on an entire industry's need for objective truth. The second method for building a terminal moat relies on weaponizing operational efficiency to intentionally suppress your own profit margins. Investor Nick Sleep defined this framework in his research on what he called shared economies of scale. In this comparison, a standard retailer attempts to maximize the red profit markup on a small volume of goods. Costco operates on a different axis, driving massive volume while maintaining a razor-thin markup on every item. When Costco's bulk buying power reduces their costs, they do not keep that money to pad their corporate balance sheet. They pass those savings directly down to the customer. This represents $5 billion of value moved from the corporate balance sheet directly to the individual consumer every year. Distributing this surplus generates intense loyalty. It drives recurring membership revenue and scales the active user base to a point where their combined purchasing power becomes untouchable. This is the exact framework Jeff Bezos deployed at Amazon, relentlessly reinvesting potential profits into lower prices and faster shipping to build an insurmountable lead. Traditional analysts often misinterpret this strategy as a weakness because the value being built doesn't appear as net profit on the quarterly income statement. The strongest market moat is built by systematically returning your profit margins to the consumer. This creates a value proposition that no competitor can match without operating at a permanent loss. Even after building a defensible moat, a company faces a final internal vulnerability. A misaligned capital structure can destroy a business from the inside out. We can see these execution risks by examining MicroStrategy's dual strategy under Michael Saylor. This balance scale shows the tension between two conflicting capital tranches. STRC is a preferred stock marketed for stability. MSTR common stock finances volatile Bitcoin exposure. When the underlying asset drops, the market demands higher yield on STRC, while MSTR's equity shrinks. To cover the mandatory payments on the preferred stock, the company must dilute its common stock, eroding the value of the exact asset its core shareholders own. If this breakdown of capital mechanics makes sense, drop a like and share the video. A market monopoly can collapse under its own weight if its capital tranches are divided against each other during a period of market contraction. Returning to the operational stack, you must audit exactly which phase your business is in today. The rules for winning change at each level. You survive Phase 1 by manually generating high-ticket trust. You scale through Phase 2 by building credence monopolies or deploying a consumer surplus. And you protect Phase 3 by ensuring your capital tranches are perfectly aligned. The quickest path to failure is attempting to use a scalable operational framework before you have survived the unscalable survival phase. Subscribe to the channel to keep studying the architecture of elite businesses. Unscalable tactics build the initial cash, consumer surplus builds for moats, and structural alignment ensures terminal survival. Follow along on Twitter for more.